here today. It's great to be here. I want to talk for the next 20 minutes, take you on a bit of a journey in financial services from conceptual projects through to deployments that are actually being implemented in financial services, blockchain projects, DLT projects. And what I want to start with actually is just to quickly talk about a couple of things. Many times people ask me, what's the innovation in blockchain and what's the benefit of blockchain and DLT technologies with regards to financial services and also in other areas as well. And I can summarize them into three sort of key areas. The first one is tokenization, very simply. Of course, I think in this room probably everyone's aware of this. Decentralization and the ability to have a delivery versus payment or an atomic swap of assets for cash and various payment for payment or whatever that is, but the ability to do atomic swaps between sort of parties. I would say if you can sort of summarize that, I would sort of summarize it in these three key areas. And I think this is where the innovation really happens, because a lot of what we're doing with this technology and this innovation is really about addressing or focusing on these three key themes, which I'll talk about in detail. In this presentation, what I'll do is I'll take you on a journey of where we see sort of these implementations taking place, but also some key topics that I think are very relevant for us. Tokenization of assets and currencies and so on, I think is beginning to have sort of becoming more mainstream with a lot of players in capital markets and financial services. And the reason for that is because it gives you the ability to sort of reduce friction in systems and reduce systemic risk as well. So that's sort of one of the key areas that we sort of see. We have sort of compressed settlement times, settlement cycles, and ability to enhance transparency. So all of these things are key themes that we think are very relevant in financial services, and especially regulated financial services. What I want to talk first about is, well, what is a digital asset? At the end of the day, without going into lots of detail, it's basically a private key that controls an asset. The key is the asset. You lose the key, of course, you lose it. So you have to be very careful about how you maintain control of the key. But it's basically a tokenized value. In other words, it's basically a further dematerialized electronic instrument. And that asset is what's stored on a ledger or on a blockchain, and having control of the key is fundamental to ensuring that you own it and control it. Some taxonomy of it as well. So there's different things around payment tokens, asset tokens, STOs, other utility tokens, and so on. So this is a quick sort of view of what an asset is and what some of the motivations to possess it, as you can see on the right-hand side of the slide. And sort of that's sort of the asset side of the story. When we talk about the cash side or the money side of it, the currency side of it, I'm going to spend a little bit more time on this because this is a concept that isn't really, I think, well understood, and because there's a number of key themes that are behind this. I want to take us on a journey a little bit on what we think is money, how we define money. And this is a consumer view of it. Physical cash, banknotes, electronic money, the ones and zeros that are in a bank account, a central bank digital currency. So many banks, central banks, and I'll take you on that story in a short while, are looking at thinking about issuing a central bank digital currency and how that can enable transactions for exchanges and commercial banks and other banks as well. And also cryptocurrencies. I include that in there because, of course, a consumer's view is that cryptocurrencies play a role in that. So that's an important sort of view of that. From a central bank perspective, central banks are very specific about what money is, and they talk about coins, they talk about notes, they talk about reserves, and a central bank digital currency is a tokenized form of liabilities on the balance sheet of the central bank. So there's a slightly different perspective on some of these, and clearly there's an overlap. So I want to share sort of the view of what money is and how we define money. And this is a long debate about it, but at the same time there are some fairly clear definitions that we should use in this dialogue. Central banks issue digital currencies. Central bank digital currencies are tokenized form of a liability, and they serve as a medium of exchange. And that could enable things in token-based financial systems, ecosystems. And we see that as also being sort of the other side of the story, because if you have assets on a ledger, that's great. I can trade them. I can and I can create sort of transactions and so on. But how do I settle those transactions? So you need to have something that is very efficient, low risk or risk-free, preferably. And sort of that's where we think that a central bank digital currency can play a key role in that. There are also topics around stable coins and how they could play a role in some of those, and we should explore those as part of the discussion as well. This is sort of what we see as sort of a CBDC ecosystem. There's retail, wholesale, cross-border dimensions. There's quite an elaborate series of different activities there, from payments to transfer to remittances, through to securities trading, through to foreign large value transactions and things like that are all part of this wider ecosystem. And they play a key role in enabling sort of this what I would call new financial system that would make use of this technology. I'll spend a few more minutes on this because I think that it's set to change the geography of liquidity and facilitates the tokenization of assets and enhances access to payments. So I think there's a lot of value in using these types of currencies. And as and when they become enabled in the wider market. And in the meantime, in the interim, there are also sort of what we see as stable coins and large commercial banks playing a role in that. And that, I think, is a sort of a key difference between some of these benefits that we will talk about in a second. I want to spend a couple of minutes and talk about what we see happening. So at the beginning of this presentation, we sort of talked about sort of from concepts to deployments. I've been working many years on this topic and have been working with many central banks around the world on sort of what on the CBDC sort of story. At the beginning of this, there was sort of a little bit of interest because they wanted to understand what the blockchain and DLT can do to enable financial systems. And when we started, this map that I'm about to show you was mostly gray. I mean, it wasn't colored at all. This is a retail view. So we talked briefly about what a central bank digital currency is, and there's a retail perspective, there's a wholesale perspective of it. And this is the retail view of what we know in the public domain and what we've seen out there in the market, both based on our knowledge and also on research that we've done. Given what's going on in the global sort of marketplace around the retail use of central bank digital currencies. And as you can see, we go from interest to research to experimentation through to implementation. So things aren't sort of taking off yet on the retail side, but there's a lot of interest in this area for very specific reasons. When we talk about wholesale, it's a different story, because in the wholesale space, there's a lot of benefits around using a central bank digital currency. And the reason for that is because it can be used to settle transactions and trades. It can be used to facilitate financial market infrastructure players, exchanges basically, to provide a more efficient settlement mechanism, ability to use it for de-risking and providing the level of instantaneous settlement through the delivery versus payment side of it. And as you can see in this slide, there's a lot more going on, a lot more activity, and I fully expect that those light purple boxes will become dark purple boxes pretty soon. A lot more in that space. We're actively working on a number of initiatives that are looking to sort of implement in production a lot of these these concepts. And if I take a look at sort of the combined view, then we bring it all together, there's a lot of stuff going on. So as I said, at the beginning of this journey, this was all gray. Now it's becoming more and more purple. And I think the message here is that this is becoming more and more real. There are a lot of applications. There are a lot of benefits of using blockchain and DLT technology. And we see the application in wholesale markets, in exchanges, and in those kind of commercial banking applications where these kind of solutions are very key. So this is a sort of a combined view across sort of global central banks. So this is happening, right? So there's a lot of activity with blockchain, not only from sort of the likes of the cryptocurrency community, but also in the banking community, but also in the central banking community through the usage of this technology to enable financial systems. So I also have a sort of slide on the non-central bank currency side. This is obviously from Thomson Reuters document that we put onto a map, and this is basically the cryptocurrency side of it. So from a regulation perspective, around the world, there's strong global advocates. There's developing points of view. There's fence sitters, as they call them, and hostile towards towards cryptocurrencies. And the idea here is that basically, if you take a look at this slide and this slide, sometimes these are inversions of one another. So where they're hostile towards cryptocurrencies, they're very accepting of and also implementing things in the central bank currency space. That's a separate conversation. So the reason why I wanted to show you that is because those are sort of fundamental building blocks that'll take us on the next part of the message and the next part of the presentation around what we see happening. So once we have assets on the ledger and we put cash on the ledger, now we have the ability to do some very clever things. And you may have sort of seen the work that was done in Canada, Jasper 3. So I was the project lead for that engagement with the Bank of Canada and with TMX. And this is sort of what the project was intended to implement, right? We put cash on ledger, we put assets on a ledger, and we enabled instantaneous delivery versus payment and settlement cycles for the entire exchange. We basically did a full day's trade through the entire ledger, technically very feasible. It proved the point that the technology was ready from that perspective. This was done from a post-trade point of view, but you actually had dollars, Canadian dollars on a ledger, TMX assets such as equities through the depository on the ledger as well. So now these things are coming together. But then this was a proof of concept. This was a conceptual piece of work, and the purpose of it was to demonstrate feasibility. So this is a major market, big exchange, largest in Canada, and one of the big exchanges from a global basis. And Bank of Canada as well was participant in that project. On the next slide, you may have heard about sort of also Project Ubin. And there was this project called Jasper Ubin, believe it or not. It was featured at the Singapore FinTech Festival in last year. We delivered that with our friends in Singapore, our colleagues in Singapore. And this was basically to do payment versus payment across two different types of technologies and two different currencies. And this was to demonstrate the feasibility that this is now possible. Actually, you can now move money from one institution to the next cross-border using distributed ledger technology, using money from one country converted to funds in another one. And this was done based on DLT technology. And this is how it actually worked, right? At the end, we had, for those that may know, hash time lock contracts. And basically, we had Singapore and Canada moving money between the two using financial institutions, intermediary banks that are in the middle of it all. And we used the technology to enable the transfer from one institution to the next. And the idea here is this technology, it proved the point. We actually did it across multiple technologies. So we had a Quorum on one side and Corda on the other. So two different blockchain DLT technologies and two different currencies in two completely different geographies. And we ran that and we showed the movement of funds between the two countries. So this stuff is becoming more and more real. On the final note, so this is conceptual. All sort of projects, proofs of concept, experiments, lots of white papers that were written behind that, and so on. And what I want to leave you with is this is becoming progressively more real. So a lot of the challenges that were set was, is this technology scalable? Is this technology secure? Is this technology capable of dealing with the volumes of transactions and trade? Can it handle the sort of the load that the traditional systems would put on a solution like this or on a technology like this? And the answer is, as you go down that list, so it's sort of like a report card, tick, 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 and we keep going down. And we've now sort of hit the bottom of that list, and sort of like, it's obvious now this technology can do it. And that's sort of what we're sort of coming to the conclusion of now. And so as a result of that, we're now beginning to see other things happen. And what I want to share with you is sort of, you may have heard of projects that are happening, or I'll talk about in a second, but sort of some of the key emerging trends that support this sort of this view is that projects are pivoting. They're going from POC to pilot, and now they're heading into production. And I'll talk about a little bit about a couple of them. Investment in R&D and the amount of money that's going into this whole blockchain DLT space is giving us a level of maturity and pushing us to a state of readiness. I think that if we talk about sort of DLT technology and in financial services, you shouldn't only look at the asset side and not only on the cash side. This is a combined view. Having a single ledger and a single view of both assets and cash is very important. So having that and proving that out, and which we've done, is a fundamental sort of building block to going to the next step. Here we talk a little bit about liquidity savings and other types of benefits. But this opens up a whole host of new opportunities. The cross-border one is a very interesting one because that's a difficult one. There's a lot of friction. And this technology can act as a really big enabler, allowing us to move into the next state of readiness for financial markets. And ultimately what I want to mention is that sort of this gives us a future sort of state of the future financial marketplace. This is sort of where things are going. A lot of the developments, initiatives, R&D, investments, and implementations are focusing in this space. So having said that, I want to talk about an organization that we're working with and supporting. This is the Swiss Digital Exchange, so S6 Digital Exchange, SDX. They're actually in the process of implementing what I would say is the first production grade rollout of a complete digital exchange, looking at putting both assets and cash on a ledger and enabling sort of the Swiss market to access that, and I would say even broader as well. So what they're doing is they're taking all of these concepts, all of the learnings, and implementing that and putting it into a production grade rollout. For those who don't know what's been happening there, it's actually quite ambitious, but also fairly achievable. And the view here is that this is the next generation of digital exchanges that are going to be coming out. I fully expect that there will be more and more actors or players in the market jumping in to start implementing similar things. But fundamentally, this is a full-scale, full end-to-end digital exchange that's putting both cash and assets on a ledger and enabling an entire ecosystem of participants to access that, trade them, move them, and so on. So this is a very exciting time. So from concepts to deployments, took you on a journey of some of the key and the basic sort of building blocks, some of the experiments that were done, some of the answers or the questions that we asked and the answers that we came to, and finally where things are now going. And I would say this is sort of the wave of the future of the next I guess the revolution of the financial system and changing of where we see things developing into. This is the first of many, and I would expect us to be spending a lot of time in the next many years on helping the market sort of develop in this way. I would like, I'm not sure how much time we have left, but if people have questions, I would like to sort of take them if they have, and maybe a couple of questions from the audience. No, there's a question over there. Yeah.
Hi, thank you very much. You dedicated a significant amount of time of your talk to central banking digital money. My question here is, who is the main initiator behind this initiative? Because one reasoning behind central bank digital currencies is making commercial banks obsolete and leaning into full money systems.
I don't think so. So if I understand correctly, the question is the obsolescence side of a commercial bank isn't the objective here. At the end of the day, it's providing a sort of an equitable access to a central bank ledger for the purposes of enabling sort of a wider financial ecosystem. So in the concept, or sorry, in the exchange world, right, there is a very specific regulation called the IOSCO regulation that requires that all FMIs settle in central bank money. The reason for that is because there is zero, in theory, depending on the central bank, zero sort of counterparty risk. And if you're implementing an exchange and you're running sort of, I have tokenized an asset, and this asset I'm trading for cash, that cash has to be something that is, there could be no sort of claim against that. It's final, the transactions have to be irreversible, final, and have full transaction finality. Only central bank money can provide you with that. And in a wholesale environment, that's the only mechanism that will allow you to provide the highest level of standard for that. You would never implement in an exchange a commercial bank money to settle those transactions, because you would be introducing counterparty risk into that transaction. You could price it, you could put it in, but you'd have to price the risk up accordingly as well. So for very specific applications, like for exchanges, FMIs, for instance, that are operating these kind of exchanges, you can't have counterparty risk, because you're now introducing more risk into the equation than you would have. So you're solving the problem of taking risk out by introducing DLT and blockchain technologies and tokenization, and then you're introducing additional risk from the type of money that you would be using. So that's why central bank money is key to enabling that to happen. So I'm not sure if I answered your question, but hopefully that, yeah. Okay, good, thanks.
Thank you for your talk. I'm wondering if centralized exchanges is still the future, really, because when you look at the development, decentralized exchanges, like Binance is doing it,
Indeed.
I think that's more the future.
Yep.
And I'm wondering why all the people always talk about regulations. You know, Bitcoin works perfect without regulation, borderless, trustless.
Yep.
So what's the point?
Yes, very good question. I'm very glad you asked that question. I didn't script it at all, but in 2 days, actually no, on Saturday we're having a hackathon on decentralized exchanges, specifically to answer that question in a much more detailed way, with academic and industry involved in providing their input into prototyping solutions around that. I'm very hopeful that decentralized exchanges have a role to play. I think they do. There is some specific challenges with regards to the decentralized exchange model, especially around things around price discovery. And so if you take a look at different types of transactions, or different types of trades rather, certain trades are could be done in a decentralized fashion. We were talking about that over dinner last night. Other types of trades, especially when price discovery is necessary and making sure that I have the best offer for my trade. So I'm selling a bunch of shares. I want to get the best price for that share, for that trade. You may have to revert to a centralized model, or have to create a very clever smart contract. So I don't know the answer fully yet. I think there's a lot of research that still needs to be done, but it's definitely worth spending some cycles on exploring that topic. So I'm glad you asked that. Question here? That's it? One more? Okay, just take that one. Just take that one for now.
Hi, I have one question. You mentioned that the technology can handle a load of the global financial system, but last year we saw that Bitcoin and Ethereum, the two most popular platforms and the ones that are being used the most, couldn't handle, 2 years ago, excuse me, couldn't handle the load of dealing with CryptoKitties and other applications or trades within the platform. Do you see that DLT technology for central banks is different and more adapted to actually dealing with this volume?
So it's very specific. So when you're using this technology, I'm not sure if you read the report by the DTCC, which is probably the largest sort of entity dealing with the most trades per day on a global basis for an exchange. We ran that engagement from a scalability point of view, and we implemented on multiple different technology platforms. And the idea was to demonstrate that we can take the entire day's trading volume and put it onto a DLT and show that it works at the end of the day. So because you're dealing with a closed ecosystem of a permission ledger, and you're not having to do lots of things like mining and all sorts of other sort of consensus mechanisms that are time consuming and also compute intensive, you have more control over the amount of volumes that you can deal with that. And so as a result, you can compress that and do it in a much more efficient way. I think I'm out of time. Thank you very much.